Hey, welcome back to the Crowdfunding Demystified podcast. My name is Salvador Briggman. Today, we're bringing on an expert when it comes to equity crowdfunding. This is the founder of Crowdwise.org. We kind of got started in the industry when it comes to peer-to-peer lending and doing a little bit of investing on those platforms. And now he's transitioned to doing investing with startup companies on websites like Start Engine, WeFunder, Republic, etc. So you're going to get his thoughts on equity crowdfunding and also how to run one of these campaigns, advice he has for founders, all that kind of stuff. This is kind of joining a thread which I'm going down when it comes to equity crowdfunding to discuss this more. And a lot of people ask me like, hey Sal, why are you talking about this other way to raise capital, like Start Engine, or WeFunder, those kinds of companies? Because Kickstarter, Indiegogo is amazing. Like you can raise a bunch of money, you can raise 6 figures, $1 million, get a bunch of pre-orders, have all the money to fulfill those orders. Like why even consider giving away shares of your company? And I was thinking a lot about that. And while it's true that I think Kickstarter Indiegogo is amazing and it's really the bread and butter of my work, at the same time, I do see a revolution that's happening when it comes to equity crowdfunding. And I feel like I'd be remiss if I was to not share what I'm seeing in terms of the trend with my audience. So I think it's an exciting time. And to be honest, I think that the judges are still out when it comes to what is the best platform. Like there's still, I'd say 3 top platforms right now in the industry, and it's still being yet to be discovered. Like we've had a couple of major successes, but it's still in its infancy. But I could see this growing so much more over the next 5 to 10 years. And it's one of the reasons why I want to cover it and bring this to you is because it's my job. I want to demystify crowdfunding for you. And if I see something going really well for a lot of entrepreneurs, I also want you to cash in on that. And I want to give you the ability to have the best information so you can make really good decisions with your brand. So equity crowdfunding might not be for you, but for some other people, it might be. And regardless, you can learn a ton about just hearing about these founder stories, how they're getting funding, how they're doing marketing, how they're creating the product and getting it out there and differentiating themselves. But there's a lot that you can learn, I think, from an equity crowdfunding campaign. The other thing that I think is really neat is one big difference between equity crowdfunding and Kickstarter or Indiegogo is with a Kickstarter Indiegogo campaign, you need at least 500 to 1,000 backers to begin to make meaningful revenue when it comes to a crowdfunding campaign. Like I'm talking like, getting to the 500K to $1 million range, you're going to be having, 1,000 to 10,000 people, depending on the price of your product, obviously. So higher price product, you need less people to hit big numbers, right? If you're a board game or a tabletop, you probably need at least 8,000 to 5,000 people supporting it to really hit some big numbers. But with a investment equity crowdfunding campaign, you can make a 6-figure campaign and only have like 200 investors. Like that's crazy to me. The fact you can raise that amount of money with so few investors, and even if you only have like 50, you can still hit really good numbers when it comes to raising capital for your company. So what this means is you have a smaller number of investors, but these people are putting in a lot of money. Like think $5,000 or $2,500 into a Start Engine or WeFunder campaign. So to me, what that says is if you don't think you have the clout to be able to do a Kickstarter Indiegogo, but you still want to raise a bunch of money and you're in a software category or something that's not easily as sold with crowdfunding traditionally, then you might consider an equity crowdfunding campaign. The other thing there is if you do end up, but just think about it, if you did have like 5,000 investors, that's a heck of a lot of investors. If you look at some of the other campaigns I've interviewed, no one has close to that. Like most people have like at most 500, right, investors. When you get into the big numbers with investors, wow, you're going to be raising a lot of money. And there is a cap right now at $1,070,000 with equity crowdfunding for regulation crowdfunding, but you could obviously do a regulation A+ campaign and raise a bunch more, upwards of $50 million in a 12-month period using equity crowdfunding. So that being said, let's get into some of the specifics here. I also have a book out there called Equity Crowdfunding Explained, which you can check out on Audible. You can go to crowdcrux.com/equity audio. That is crowdcrux.com/equity audio. Crowdcrux.com/equity audio will take you to the book, Equity Crowdfunding Explained. And at the end of the show, I'll show you, if you want to, you can work one-on-one with me preparing for your launch. But that being said, let's dive right now into this podcast episode. This podcast episode is sponsored by The Gadget Flow. The Gadget Flow reaches over 28 million people, and they've been around since 2012. They are Indiegogo and Kickstarter experts. They featured over 5,000 crowdfunding campaigns, and if you have a technology or design campaign, it is a great platform to generate awareness and get backers. You can check them out at thegadgetflow.com/submit and list your project today. Hey guys, welcome back to the Crowdfunding Demystified podcast. I have Brian here from Crowdwise.org. He is an expert in equity crowdfunding, and I brought him on the show to talk a little bit about the changing industry, as well as his thoughts on how, as an entrepreneur, you can actually use equity crowdfunding nowadays to get investment for a company, but also as an investor, how you can participate in the next great startup. Brian, welcome to the show.
Thanks for having me, Sal. I'm really excited to be here.
So can we get started here a little bit with your passion? Because I think it really takes a lot of work to be willing to educate and talk about any kind of topic online. Like, where did you get passionate about equity crowdfunding?
Yeah, and that's a great question to kind of set the stage, because when you think about equity crowdfunding, what it's really doing is kind of unlocking a new opportunity that was kind of off limits for most investors prior to the Jobs Act in 2016. So my background actually has nothing to do with finance or investing or, startups or crowdfunding. I'm actually an engineer by training, but I've always had this real passion and interest for investing and have always been in alternatives, whether it was debt crowdfunding and then kind of getting into crowdsourced real estate. And then finally in 2016, when the Jobs Act legislation went live, that's when I really started investing in some of these startups and early stage companies. So my passion and what I've built Crowdwise into has been kind of born out of my own frustrations in the space, where someone could be very familiar with how to invest in public market stocks or bonds, or even the entrepreneurs may be, familiar with raising capital. But when it comes to equity crowdfunding, it's kind of a whole new ballgame, and it's still a really evolving industry. So I saw a gap and kind of an opportunity there where I wanted to give back to people and basically share my own knowledge and learnings. So that's where I got started.
What kind of engineer are you, by the way?
Yeah, so my formal training is in aerospace and mechanical engineering. I got a dual master's degree in those.
Wow, that's cool. I just saw the SpaceX launch the other day.
Yeah, that as a quote, rocket scientist, that is just, it gives me the goosebumps. It was definitely a really inspirational thing to watch the other day.
Yeah, that was insane, man. And stuff that Elon's got planned, like he's taking us to Mars, all these other things, really cool.
Yeah, and it's my prior life as that engineer. It's not that the work was incredible, it was interesting, but I just think my passion has always been more of kind of working with these smaller, earlier stage companies, entrepreneurs, and then from the investment side, helping the investors. So that's really why I kind of made this, I'll say, late career change.
With your own investing activity, you talked debt crowdfunding. Do you mean like those peer-to-peer lending companies like Lending Club and stuff, or what were you referring to?
Yes, exactly. And the way I usually, when talking about crowdfunding, and your audience is obviously very knowledgeable on this, but it's always helpful to kind of break it down into the different buckets because there are the different types. So typically there's the one that a lot of people are familiar with, rewards crowdfunding. So the ones like Indiegogo, Kickstarter, that type of thing. Then the next bucket is that debt crowdfunding. And that's like the peer-to-peer loans through either Prosper, Lending Club, that type of thing. I did that for many years in the early 2010s. And then equity crowdfunding is kind of the new kid on the block, if you will, where instead of just getting, either a note or maybe a trinket or a t-shirt or a product, you're actually getting actual shares and equity ownership in the company.
Mm-hmm. How did that go for you? Because I've kind of heard mixed messages with the debt crowdfunding in terms of investing in Lending Club and like these other types of companies, that it was kind of like mixed. What was your experience with that?
Yeah, in all honesty, I kind of used maybe something that would be, in terms of the investment world, diversification. You want to place a bunch of really small bets. So I'm investing $25 across thousands of deals in terms of the debt crowdfunding. And the way it works out, right, when you do that and you kind of spread your risk, is that you'll get closer to kind of the expected returns, where if any one deal goes bankrupt, it doesn't necessarily affect your portfolio. Now, all that being said, after defaults and everything else, I was probably looking at like a 6 to a 7% kind of IRR, which isn't bad.
It's kind of like a bond, yeah.
Yeah, it's exactly. It was kind of like that. It had pretty stable income, right? You didn't have the volatility of like stocks, that type of thing. But I sort of, I'll say, was maybe looking for a little more excitement and maybe a little bit higher return, which is what kind of brought me to the equity crowdfunding side of things.
Okay, one other quick question. When it comes to the real estate crowdfunding, were you doing things like investing in the REITs, or were you investing in the individual properties, or what were you doing there with the crowdfunding side?
Yeah, that's a great question. So I had previously been investing in public market REITs already, and really the one that kind of got me started in the space was probably Fundrise, where I was investing in some of their e-REITs. Now, I know for accredited investors, the people who have over $200,000 income or $1 million net worth, you can invest in some special and kind of more like localized deals as well, kind of in individual properties. But I was mainly sticking to the REITs, which are kind of the funds of the real estate investments.
Okay, understood. Do you still, engage in that?
I do, yeah. I've still been investing primarily on the Fundrise platform. There's a whole bunch out there in terms of crowdsourced real estate, and you can kind of pick and choose whether you might be interested in more equity deals, debt deals, different types of, whether it's mortgage or different things. So there's all these different types of investment platforms, but I primarily use Fundrise.
Very cool. There's like this whole growing trend of alternative investments. Like you have crypto, right?
Right.
And you have these privately non-traded REITs, debt, and then you have equity. Like there's this whole growing industry, I think, of alternative investing.
For sure. Yeah. And that's really where kind of the niche that I'm trying to help serve is within that alternative investment industry and kind of the equity crowdfunding side.
When I was first getting started, like I was watching this happen, and the Jobs Act kind of got me interested in the whole thing back in 2012. That took a long time to come to fruition. And then I wrote like a simple guide, Equity Crowdfunding Explained, because I feel like no one else out there was really educating on this stuff, right? And for me, like, I think just getting a sense of, as an investor first, what the opportunity is, and then as an entrepreneur, like I think that would be a good way to proceed with the show. So for you as an investor, like who can participate in these kinds of deals? Like where are you going to even find startups to invest in? Would love to hear a bit about that.
Yeah. And I'll just take a step back, and I want to, again, thank you for, writing that book, because as I mentioned to you in the past, really when I was getting started in the space just a couple of years ago, your book was one of the only resources out there I could find for people who wanted to get started, either as an investor or an entrepreneur. And so that's kind of where my real passion for helping to add to that education came from. So in terms of, your question, why is it different, right? So if you look back in history, pretty much since the Great Depression era, it's pretty much been illegal for non-accredited investors. And you can just think of those as, your typical American, the 97%, I think, or so, who have less than $1 million in net worth and make less than $200,000 a year. For those people, which is the majority of Americans, they couldn't invest in early stage private companies. And for a lot of the times, if you think about it, you might have a friend, you might be an employee of one of these companies. There's all these different circumstances, but essentially just because of your net worth and or income, the SEC, for quote, your own protection, would prohibit you from investing in these deals. And fortunately, with a lot of the changes in 2012 that the Jobs Act came, and then when it went live in 2016, they realized, the SEC, in reflecting on some of these rules, is that we allow people to gamble. You can go to Las Vegas and there's no limit. You can bet whatever you want on, roulette or any other game.
No limit hold'em, yeah.
Exactly. But when it comes to investments, people who might actually have the knowledge and the sophistication were being prohibited simply because of their income or net worth. And it wasn't fair. It wasn't American, to be frank.
Yeah, it's BS. Yeah.
It is. And, there's still today, I'm not going to say it's perfect. There's still kind of a lot of limits in the regulations, and there's some proposed changes that we'll probably talk about that are actually going to address a lot of those as well. But what it essentially did is it unlocked the private markets for those majority of Americans to allow you to be able to invest in, whether it's the brewery down the street, a restaurant, a film, or it could be, the next potentially great tech SaaS app, something like that. So it's really exciting, because if you look at public markets and IPOs have been kind of trending downwards recently, and companies are staying private longer. And if you think that you could necessarily just invest in index funds, you might be missing out on some of those early capital appreciation gains that are happening in the private markets. And basically, this allows investors to now tap into that. But from the entrepreneur side and the issuer side, is what they call them, who raise the capital, it's also now unlocking this opportunity where in the past you had to go to your networks of angel investors or venture capitalists or very small, tight-knit communities who controlled the funds. Now you can basically approach the crowd and let the crowd decide whether your idea is good and should be funded and they want to see it or not. And so what you're seeing now is a lot more diversity in ideas, in founders, in companies that are being funded, because it's not necessarily up to that small probably non-diverse community of venture capitalists who have traditionally been funding these.
Can you give us an idea of this past year, like how much in terms of funding has gone through equity crowdfunding? Can you give us an idea of like some of the statistics when it comes to that?
Yeah, absolutely. So just to put things in perspective, again, it really launched for non-accredited investors. It's called regulation crowdfunding in May 2016. So we're coming up on just passing the 4-year mark now. And after 4 years of being live, it has now surpassed roughly $367 million raised from the crowd. And a little bit over 100 million of that was just in the last year alone. So the year over year growth for this is really exploding. Where, the first year in 2016 and 2017, it was this brand new thing. People didn't know what to expect. There were concerns. As an investor, do you have to worry about fraudulent companies online? The great news there is that there's actually been 0 cases of fraud so far in crowdfunding, which is one of the reasons I think the SEC is kind of looking now and saying, how can we kind of revise this and actually give it kind of a boost to help it get
More
to
teeth.
the next level.
Yeah.
Exactly. Yep. Because you got to be cautious. Anything with securities and money related, right? There's always going to be fraudsters, unfortunately, who come in and want to take advantage of people. But the good news is that hasn't happened yet.
So you said it was about 100 million last year?
Yeah, a little bit. I think the exact number is probably escaping me. I can pull it up, but it was definitely over 100 million last year alone in 2019. Yeah, it looks like 137 million in 2019, which was actually up about 60% year over year from 2018. That's in capital commitments. But if you look at the number of investors who invested, that was up over 100% year over year from 2018 to 2019 rather. So there were over, I think, 250,000 investors last year alone. But if you look at some of these portals, they have on the order of WeFunder, which is one of the top equity crowdfunding portals, has over 600,000 investors just registered on their platform.
Insane.
So
that's crazy.
The growth rate is, and honestly, that number I think was 300,000 a couple months ago towards the end of 2019. So that alone has been doubling. And, the growth is just really starting to pick up from both sides of the marketplace.
Yeah. I mean, I've totally noticed that. That's one of the reasons why I've been having some more equity crowdfunding campaigns on this podcast. And I think it's a huge boom. Like we're starting to hit a little bit of a critical mass, like just starting to near edge towards that process. Why do you think that is? Like, why is it now starting to catch on more?
Yeah, that's the question everyone's been asking, and with all this growth, it's like, why is it happening? And when I kind of look at where equity crowdfunding is today, I would probably attribute that to a combination of 3 things that have really just hit in kind of the first half of 2020. So the first thing, and this started kind of before the pandemic and everything else hit, but the SEC has been proposing new regulations. And these regulations are looking at everything from that accredited investor definition I was talking about before, where instead of just basing it on net worth or income, they want to base it more on actual financial sophistication. Like if you have the knowledge and you acknowledge the risk, you should be able to invest. So they're looking at that, but also basically they're looking at revising all of the exempt offerings, which is like the regulation crowdfunding, which would increase the limits for investors, increase caps, and it's starting to give it a lot more attention. So that's kind of bucket 1, if you will.
And the limit right now is what?
So the limit right now for companies that want to raise is 1.07 million, but the comment period just closed. So the SEC has proposed new rules that would increase that to 5 million.
Yeah, that's pretty sizable.
Yeah. Because, you're putting in the work and you got to do a certain amount of, the biggest thing is usually the financial audits that are required depending on the different thresholds you want to raise.
So what I've noticed too, a lot of these companies will do like multiple rounds. I think that would eliminate and make things a lot simpler if you could just raise it just a little bit that way. And you really get the attention of so many more people, right?
Absolutely. Yep.
What was the other bucket? Sorry, I didn't mean to interrupt you there.
So the other bucket, and obviously no one would have planned for this or wished this on the world, but the pandemic, COVID-19, when it hit, has really kind of been an accelerator of different industries and trends that may have played out over longer time periods. So, the big example a lot of people are probably familiar with is video conferencing calls, right? Like, all these people now, they're working remote and it's kind of accelerating some of these trends that may have been moving on in the coming years, but it's really forced it now. So when you look at the crowdfunding and kind of early stage capital market industry, what you see is a lot of traditional angel investors and venture capitalists have kind of tightened the belt, if you will, right? So capital has dried up a little bit in the private markets. Obviously, a lot of early stage companies are at risk of going bankrupt or, running low on cash. And so what that's actually been doing is forcing them to look at some of these alternatives that they might not have considered before. One of these being crowdfunding and using something like equity crowdfunding. So the top, I think, 3 or 4 portals unanimously across the board in the past few weeks have all said that basically the last month, the last quarter, even the last few weeks have all been record breakers for all of them in terms of the number of companies applying, the number of campaigns launched, and all those associated statistics.
It makes so much sense to me also because when it comes to these other private markets, like you really have to take a lot of risk. If you're writing a $50,000 like angel investment check, like that's pretty risky. Same thing if you're doing like $100K, you're putting that in a company. With equity crowdfunding, you can put in a much smaller amount, right? And
Absolutely.
it's more of like something where you can put in $500 or $100 even, right? So It really is a different class of investor, different type of investor.
It is. And it kind of, if a lot of angels will tell you shouldn't invest more than, say 5% to start of your investable assets in startups because they're risky. And honestly, more of them are going to fail, most likely, than statistically speaking, than are going to succeed. But the hope and the way that kind of the math for the returns works out is that those 1 or 2 in your portfolio that do succeed basically have power law huge returns that return more than the rest of your portfolio combined. So the important thing there of someone who is a fan of statistics or math can think about is that if you're only making one bet on that one company that's more likely to fail than succeed, you're probably not going to do well in your investments. So exactly to your point, it lets you diversify, place a bunch of small bets, and then have a better chance of kind of having better portfolio returns for your early stage investments.
The other thing there with COVID, was there some other announcement that was made that kind of removed a little bit of the burden of having your accounting be looked over by an accountant, or what happened there?
Yeah, so the SEC basically approved some interim rules that are in effect until I believe the latest date was the end of August of this year as of right now. But it basically says that for companies who have already been established for 6 months or more, so unfortunately you can't just be a company who's raising right now, I decide to incorporate and I'm going to go raise capital using this. But if you are already established for 6 months or more and you meet a few other little requirements, it basically reduces some of the burdens of being able to raise capital. Some of them are these relaxing of the financial auditing requirements, depending on how much you want to raise up to. In addition to that, basically some expediting of the process that it takes to kind of file for your campaign and then get your funds after the campaign. It helps to expedite some of that so that these companies can get access to the capital much faster than they would have traditionally been able to.
If you're worried about the fulfillment and shipping part of your Kickstarter campaign when it comes to getting out all those perks and rewards to your backers, rest assured, I've put together a complete Kickstarter fulfillment and shipping checklist for you, and it's free. This is sponsored by the folks at Fulfillrite, and they thought that you should have this checklist as part of your arsenal going into a crowdfunding campaign. If you want to get instant access to this checklist and it's free, you can go to fulfillrite.com/checklist. Again, that is fulfillrite.com/checklist. fulfillrite.com/checklist. Just go to that link and you can download it immediately. Very exciting. Very exciting. We live in exciting times.
It's extremely exciting.
When it comes to like these investments, you're a very numbers oriented guy, I can tell, right?
Mm-hmm.
And you're very strategic with your investments, I'm sure. Do you have any strategy when it comes to investing on these platforms? Like, is this still like the Wild West, you think, where there isn't really anything you can do aside from put your money into the companies you like? Or like, what do you recommend for investors if they want to get started with this?
Yeah. So what I started out myself and has been working relatively well so far is really following some of the similar principles that angel investors or venture capitalists might use to screen a company. But all that being said, as I mentioned before, one of the benefits of equity crowdfunding is that it lets you fund some of these more non-traditional ideas that might not have met the mold of VC, so to speak. So one of the things, right, if you look at a couple different models that angel investors will use and one that I use for kind of myself, team is obviously it's one of the most important areas when you're assessing something. So that's especially the founders of the company. And what you're mainly looking for there, right, is this someone that is really passionate, that is going to stick with this idea? Or do you think this is someone who's maybe just doing it because they thought it would be cool? They might not stick it out necessarily when the going gets tough. So one of the biggest things that I look for is, again, kind of that team and the founders and if they're committed. But in addition, as you mentioned, I want to invest in things that also excite me. So the product really matters as well, and making sure that the market and the market opportunity, that it could grow into something big. As I mentioned, if most of these companies are going to fail, the ones that do succeed have to succeed big if you're looking for financial returns. So making sure that the potential market is huge. And basically you can look at all these things and you can screen it on the campaign pages. But in addition, doing things like founder interviews and looking and seeing how the founder interacts, kind of all these things can come into play and supplement some of that you might not have, where if you're an angel investor, you might fly and meet with everyone before you invest in them, right? Well, crowdfunding investors online, unfortunately, don't have that opportunity. So you get to look at other resources that you have at your disposal. You can look at past experiences on LinkedIn, for example, see what some of their past companies were. There's different ways to kind of go about that.
The other thing there being understanding what they're going to use the money for, right? Because some people I feel like are just raising money in order to get to the next stage where they're going to raise more money, and they don't necessarily have a concrete plan like, okay, we're going to put it into these separate things or these buckets, or we're going to buy ads. Like someone who has a bit more of a concrete plan for your money is always going to be a much better investment.
Absolutely. Yep.
If you have like someone who's just trying to like, well, I want to get money so that I can pay myself, like pay my staff, like that's obviously not going to be a really good investment. And it just makes me question their planning ability, right?
Absolutely. Yeah. One thing I think about in that situation is like, anyone can go and raise money, right? But why is right now the right time for you to be raising money? And if you don't have a good answer to that question, if it's to your point, paying my employees to keep the lights on, well, okay, how am I going to get a return on that? Whereas if it's something more like I need it to be able to build some hardware products, to be able to scale, or something else that unlocks some value that you can't achieve with your current capital, that's really where the opportunity comes in.
Another one is, I think, the product market fit, right? So have they already entered and penetrated into the market? You can literally see their financials, right? So you can see if they're selling things or not. Have they already capitalized on demand? Have they identified that demand? Do they have product market fit? As an entrepreneur, that's your goal, is like getting product market fit. And that's like the holy grail. So I think as an investor, you can also look for that in these different companies.
Yeah, the product market fit, you'll see companies that are at all different stages. Some will really be in kind of that sketch on the back of a napkin phase where they maybe have a concept, but nothing really started yet. And you will see even some later stage companies who are raising using Reg CF up to even though it's a 1 million cap, because they see other benefits in getting some of that branding, the marketing exposure. And honestly, you're turning your customers in a lot of these instances into your investors. And that's creating, long-term alignment and kind of can help you get more of that traction and get to the next level.
Yeah, being a part of the customer base where you're someone who uses this product or you're very intimately familiar with the industry, I'm sure that would help as well. Just because then you have it's always risky investing in a public company that you don't understand, because you don't know the customer base, you don't know what's happening behind the scenes. But if you're already like a fitness goer and you come across a fitness product, you know whether or not that thing is good, right?
Absolutely.
Or if you're traveling around the world like Brian, right? and you are assessing backpacks, and this one is just like leagues better. You know that, so it would make a good investment, right?
Right. And I try, honestly, using most of the products or services if I can before I invest in any company. It's a good way to get a feel, where are they at today? Kind of how is their level in terms of where their product is at? And can they actually sell it? And do you think that it's a viable product for that product market fit?
Just on a quick segue here, I was looking at your travel map. You've been to a lot of countries, man.
Yeah. So the one thing I left out in kind of my career change is between being the aerospace rocket scientist in 2018, I actually took a year off and traveled the world for that year, which in hindsight, obviously very fortunate in terms of everything going on today in the world that I was able to do that. So yeah, we went all over the place. Europe for 6 months, Australia, New Zealand, Southeast Asia, all over the place.
Did you learn anything about yourself during that travel experience?
Oh, absolutely. And in all honesty, when I left for that from my prior job, I had every intent of going back and returning to kind of the aerospace engineering position that I had. So it was really during that year of travel that I kind of figured out what I really wanted to do, where my passion was. And I think kind of understanding for myself that it wasn't necessarily all about getting the biggest paycheck I can get or the best title in the company, but doing something that I was passionate about and that I felt like I could help other people and that doesn't feel like work, honestly. And so that when I came back from the travel, that's when I actually started Crowdwise and kind of jumped into this whole second career, if you will.
I can't tell you just how important travel is. Like for anyone who's listening, as a business owner, you get so many creative ideas because you'll see other products existing in other countries and you're like, why doesn't that exist back home? Right.
Mhm.
Or when I was in the Philippines and Corona was starting to hit, everyone's wearing masks. I'm like, why is no one wearing masks back home? And it's like, you just see all of these different discrepancies, right? It's almost like arbitrage in a sense, and it can really lead to lots of interesting ideas.
Yeah, it's incredible. And, in some ways, the US is ahead of all these other countries in certain places. But then in other ways, all these other countries are way ahead of the US. Like, I think I was talking to someone in the UK and maybe even Australia, and they were saying DoorDash and other delivery services have really kind of just been getting big in the past couple of years in the US. And they've had that for, decade.
Yeah.
In some of these other places. And it's like, why are we just getting this now?
Or in South Korea, looking at the way they handled Corona and like having apps that will give you notifications. Like if someone built that out, that would be such like a no-brainer, for the United States.
Yeah.
But we just aren't doing that. So lots of opportunities out there.
Absolutely.
So I kind of want to use that segue just to talk a little bit about like entrepreneurs in the audience and what they should know about equity crowdfunding. How easy is this for someone to do? Like, what do they have to have their ducks in a row in order to get started on one of these things?
Yeah. So for the entrepreneurs and the businesses who want to raise, as I mentioned, there aren't technically any requirements. You could be kind of in that pre-revenue where you don't even really have a product yet stage. However, you're probably more likely to be successful if you do have some type of product where, to your point, you have demonstrated either some early traction or product market fit. Now, in terms of going back to the numbers for a second, the average campaigns tend to raise about $260,000. And I think that the success rate so far with equity crowdfunding has been around 60%, which may sound like kind of bad that 4 out of 10 companies are failing. But at the same time, when you consider that traditional venture capital and companies who approach them, I think the success rate is like 2%. So it's way more successful.
By success rate, do you mean successful raise or the successful company?
Successful raise.
Okay.
Yeah, it doesn't necessarily mean that they're going to go on to be successful, but being able to get that money.
That's about twice as high as Kickstarter, Indiegogo too.
Okay. Wow. Yeah. So as I was mentioning, right, the bar to get started is, I'll say, relatively low. So everyone has to file what they call a Form C with the SEC, but that's not even something that the SEC technically approves or not. It's something that you file, and once you file that, you can launch your campaign. So depending on the website that you want to go to, some of the websites basically don't have any type of threshold. They don't require, any of your revenue or even that you're a good, quote, business or investment opportunity. So those websites are like, the WeFunders, the Start Engines. They basically, if you apply, you filed your Form C, and they think you have a reasonable chance of meeting your minimum goal, you'll get approved. Now, there are some other websites that actually try and look more and do their own due diligence, where you basically will have to kind of pass a test where they kind of will screen you as a company, and then they only offer good investment opportunities to their investment communities. So some of those are like Seed Invest and Republic.co and other companies and portals like that.
Okay, so this Form C, what does that kind of say? I'm just trying to raise this amount of money. I'm just trying to do this. Like, what can you break that down for people?
Yeah, it's a lot of the basics of your business. So what's your formal legal name? Where are you located? How much money are you raising? What type of financial security? You're going to be offering stock. Is it going to be something like a safe or a convertible note? There's these different securities you can sell and offer. And then things like your minimum goal, your maximum goal, and then just basic things like we were talking about earlier. What are the funds going to be used for? Basic risk disclosures. In all honesty, I think some of these portals will tell you that you can probably, for the most part, get your Form C together in less than a day. In terms of getting all the info, it's pretty objective stuff. The harder thing is typically crafting your campaign page, right? You got to make the really compelling story. Most of these, similar to, kind of the Kickstarter world, you'll have like a video or something up top. You can design still perks. So even though your investors are getting kind of financial stock or equity, you can still give perks kind of similar to the rewards crowdfunding model. And in addition to that, right, you got to basically do the other thing that can take a long time is depending on the amount you want to raise, that financial audit or kind of self-certifying your financials, depending what that threshold is that you're raising up to.
When it comes to the amount you can raise, so there are sort of like different tiers, if you will, and obligations, right? So I kind of just want to quickly talk a little bit about that and just give people a very broad level idea. If you're trying to raise, let's just say like $100,000, what are the requirements, or are there any?
Yeah, that's a good question. So typically I think that I could go back to the regulations to get the rough numbers, but it's roughly if you're raising, I think it's 107,000 or less because they try and adjust for inflation. Typically, I think you can just self-certify your financials along with like tax returns. The next threshold is usually around, say, 100 to 500,000 that might require a review by a CPA. And then if you're going from kind of that $500,000 to up to the 1.07 million max, then typically you need, I think, to have an audit by a CPA. So it's kind of like different levels of audit required or disclosure required, depending on the amount that you're going up to.
So technically, I mean, if you're raising under $107,000, it's pretty easy. Like you don't even need to have a CPA look over this.
Yeah, and to be honest, a lot of these companies, if you look at their financials, it's all zeros. For a lot of the ones that are just getting started, it's not a lot. It can be a little bit more work, obviously, if you've been around for a few years, or maybe you're kind of pivoting or changing your business. You got to make sure your ducks are in a row. But again, I'll say the financials are something that's being reviewed in the new proposed rules as well, where they're trying to make that a little bit easier for the issuers as well from the SEC.
When it comes to raising a bit more, can you do something like you raise $100,000 or $107,000, and then you're like, okay, we actually want to raise more? Like, can you do another round, or can you extend it in some way?
Yeah, and there's actually a lot of companies who seem like they do that. I don't know if they do it on purpose, but they will set their initial campaign and say it's $100,000 max. And when you reach that, if you go and you can basically amend your Form C, do the additional audit or whatever's required from a financial perspective, and then you can basically reopen your campaign and then raise up to, the $500,000 or the $1 million. So a lot of these companies, the cap is a rolling 12 months, so you can raise up to $1 million over any 12-month period, but you can do kind of any number of campaigns or kind of different combinations, and people often extend it along the way to be able to, if they think that more money's coming in or that they want to raise the cap or that type of thing, you can definitely extend your campaign.
So really interesting, easy way to get started would be to do something like, hey, I'm interested in this equity crowdfunding thing. Have some people who maybe want to become investors in my network. I know I could do a very simple regulation CF, raise 100K, 107K. And then from that point, decide like, do I actually want to go out there and pay for audited financials or to have a CPA certify that? So that could actually be a viable path.
Yeah, and I think it's been interesting. Some of the companies that I see, I wonder if they're actually doing that deliberately in some instances, because what will happen is once the 107,000, the allocation to that is reached and maxed out, you're now gathering a wait list. And I kind of see that as, almost kind of a FOMO, fear of missing out tactic, where now people are like, oh, I missed the initial round. When are you guys going to reopen? When are you going to extend the campaign? And they're getting kind of that wait list in the meantime. And then they're like, oh, okay, we'll raise the cap a couple weeks later, whatever it takes. And then you kind of have additional momentum carrying your campaign through.
Are you familiar with the test the waters period?
Yeah, so that's another thing that's
Reg A plus, right?
I think.
Today it's Reg A plus, but that's one of the things with these proposed SEC changes that they want to streamline between Reg A plus and Reg CF so that they would basically allow it and kind of relax some of the demo day and other communications rules to be able to, allow companies. And it makes sense, right? Some of these companies, you might already be $10,000, $15,000 in the hole from all audits or legal fees or other things. And then if you raise and don't reach your campaign minimum, you got to return all that to investors and you basically lost that money. So it allows them to kind of do get some feedback from the audience without necessarily soliciting sales or violating any SEC rules.
Yeah, I think kind of the way to think about it now is that the raising up to 100,000, that's almost like the test the waters, right? Because you're like basically seeing, are people interested in this? And if they are, then you can go to the next level, right? So it's almost like you're running like your own test the waters. No, obviously like it's different when it comes to like non-binding commitments of interest and stuff. But for someone who's just getting started, like that can be a really easy way just to see whether or not this is something for you.
Yeah.
And can you actually coalesce people around this idea? And if it doesn't work out, you could always do a Kickstarter, Indiegogo, or another type of fundraiser, or you could go, to traditional angel investors and VCs in the future. But I think that's a game changer to me. The fact that you can actually amend your Form C and you can raise more money, like that's a marketing strategy right there.
Absolutely, yeah. I won't say it's non-trivial to be able to amend stuff, and you got to coordinate with the portal that you're raising on, but it's definitely something that's doable.
Very interesting. Cool, man. Well, this is a lot of good information. When it comes to this process, are there any other things that you want to talk about that are on your radar or that you're seeing happening in the industry you want to share?
I think that just at a broad level, when Reg CF was initially launched in 2016, there were a lot of negative connotations, right, that kind of came with it. I think at the time, there was still this huge uncertainty because no one had really done it yet. So no one knew if it was going to be successful, what the fraud would be like. And honestly, a lot of venture capital firms and traditional angel investors really thought that only second-rate companies and entrepreneurs and issuers were going to raise using this. And they figured that only people who can't raise from traditional angel or venture capital will go to this. And because of that, I think there was sort of a negative connotation where I think some entrepreneurs and companies may have avoided it because they were worried that it would almost give them a stigma, seeing that we raised capital from the crowd in the past might hurt us in the future.
Yeah, no one wants to be first either. Right.
No one wants to be first, right? But I will say, and especially I think in the last 6 months, that really seems to be changing just from the industry perspective.
Heck, Kevin O'Leary is working with Start Engine now.
Yep. Kevin O'Leary has come on. Robert, I can't pronounce his last name, Hershevek, is also kind of endorsed another, and Neil Patel, they have something called Angels and Entrepreneurs, which is also in the equity crowdfunding space. So there's a lot of bigger names coming into it. As we mentioned, all the growth, it's really taking off. But I think even some traditional angels and venture capital firms now are actually recommending to their companies like, hey, you're probably too early for us right now. Why don't you go and do an equity crowdfunding campaign, demonstrate the actual need that you can raise capital, get some customers, and help kind of get you to that next level. When you do, then come back to us. So it's not really looking to replace venture capital or angel investing, but really try and help to bridge that gap between maybe, the early friends and family or pre-seed round until you're maybe something that's a little bit more ready to bring to VC.
It's also one of those things where you don't need a tremendous number of people in order to raise a decent amount of money. Like, just getting 100 investors together is very different than doing a Kickstarter or Indiegogo. You get 100 investors, 100 people, backers. Like you'll raise maybe like 10K or something around there. You get 100 investors together, like you can raise significant amounts.
Yeah. To give your listeners a quick perspective, so while the number of investors is kind of an 80-20 breakdown between non-accredited, so these are the smaller investors who are probably doing $100, $500 checks, and maybe by numbers, 20% of them are the accredited investors who are writing maybe $10,000, $20,000, $50,000 checks. The amount of capital is actually kind of flipped, where 80% of the capital is coming from those higher check amounts. So to your point, you could probably raise a lot more money with fewer people for sure.
Yeah, well said. When it comes to this entire process, like what do people have to give away? That's one last thing I think we should touch on is as an entrepreneur, what would you say is an average amount that people are giving away in terms of like percentage ownership of the company? I know this doesn't work like fully that way, but just like an idea.
Yeah. So to put things in perspective again, if you kind of look at traditional, say, VC, you're probably like in a Series A round giving away anywhere from like 15 to 20, 25% of your company even. Typically, what I've seen on a lot of the earlier stage Reg CF offerings is it's probably a smaller amount, maybe in the 5 to 15% range, but it really does vary. So that's really up to the entrepreneur and kind of the business in terms of what they set the valuation at and then kind of how much that implies that you're giving away based on how much you're raising.
So I'm going to make a prediction. I think the exact same thing that happened with Kickstarter, Indiegogo is going to happen with equity, where we now have people who are running Kickstarter campaigns just for the marketing exercise, basically.
Yeah.
And just to get the word out there, to get people backing it, and to get in the eyes of other potential retailers and stuff like that. And I think the same thing is going to end up happening in the next 2 to 3 years with equity crowdfunding.
I definitely could see that happening. And it's to some amount, there's already been several companies that I've seen where when I've asked because you can ask basically post Q&A, and I was like, okay, you guys have all this capital, you're really late stage, why are you raising from the crowd? And sometimes the answer is really, we're looking to kind of just get the marketing exposure and get more people on board with our brand.
Well said. Well, I think this is a really good time. So thank you for doing the podcast and educating about all these different topics. For those that are interested, you can go to crowdwise.org, CROWDWISE. A lot of great content there. But I look forward to having you back at some point. We can go more in depth into one of these topics, but I appreciate you coming on and sharing all of those great tips.
I would love to come back, and thank you so much for having me, Sal. I had a great time chatting with you today.
Hey, thanks for listening to this episode of the Crowdfunding Demystified podcast. If you did not catch it, my name is Salvador Briggman. You can look me up on YouTube. I got a YouTube channel. I also got a blog, crowdcrux.com. And finally, I wrote the book, Equity Crowdfunding Explained, which might be relevant to you if you're trying to raise money for an equity crowdfunding campaign on whatever platform out there. This is really, I think, one of those things where it's growing a lot in the last couple of years. I think last year was a really breakout year for equity crowdfunding. And I think this next 2 years are going to be even bigger. And in particular, when the capital markets like investment bankers and venture capitalists and angel investors are a little bit shy about putting money into startup companies because of finances, because of economy, because of world events or something like that, we're still seeing actually more growth in equity crowdfunding because people are raising smaller amounts. I realize it's a large amount, but like $1,070,000 is not a big amount when it comes to feeding a technology growing company. Most of these tech companies eventually have to be raising like $5 million, $10 million, $20 million in order to really get the races going on the races, in order to do anything when it comes to accomplishing bigger things in their marketplace. So this is really something where I think it's a great place to get started. It's really a needed space. You can invest in companies if you want to. And as an individual or as an entrepreneur, you can run one of these campaigns without terribly many investors. You can raise a bunch of money, and you can do this now. Like, there's nothing stopping you. You can get this done in the span of, I think, 2 months to 3 months. So this is really exciting. It's really exciting time. So if you want to book a one-on-one coaching call and discuss this for your specific startup or company or organization, we can get into that. But the link to book that call would be crowdcrux.com/coaching. That link is crowdcrux.com/coaching. Crowdcrux.com/coaching will take you there, and you can book a one-on-one coaching call with me. This is an hour-long intensive call. Bring all of the documents that you have you want me to review. If you want, I'm happy to sign an NDA with some of those calls if you have something really proprietary. But other than that, I think that when it comes to this new industry, the most important thing is knowing how to drive traffic, knowing how to get people on your page. And if you've been running a Kickstarter before, you probably have a sense of how to do that. But it's a really big question mark, I think, for so many entrepreneurs out there. And I want to help you with that process. So thank you for listening to this show. Go and check out some of the other ones we got in the archives. Again, my name is Sal, and I will see you next time.